Hello everyone and welcome back to a new quick video where we are covering business economic topics in a practical manner. So without wasting much time, let's get back to our screen. So we are now today starting a new chapter 3, theory of production and cost, in which today we will be covering unit 1, that is theory of production. So we will be starting with an example. Meaning of production. Imagine you are a farmer in Punjab. Every season you plant wheat, nurture it, and eventually harvest it to sell in the market. The whole process from planting to selling is called production. So, definition: production in economic means transforming resources that could be land, labor, capital, and entrepreneurship into goods and service that satisfy human wants. So, example: when a carpenter makes a table, he doesn't create the wood, he transforms it, adding utility. So, there are various factors that are responsible for production. So, factors of production: think of a Bollywood movie production, it involves actors, directors, cinema, camera, location, and script. Similarly, production in economics involves several key factors or key resources. First is land, natural resources used in production, example soil, water, minerals. Second, labor. Labor is human efforts both physically and mentally, example a farmer planting crops, a teacher giving lessons. Third is capital, that is man-made resources, that is machinery or building. And fourth is entrepreneur, the person who organizes these resources and take risk, example could be a startup founder. So I added a short example for it. In a tea plantation in Assam, land is the tea garden, labor is worker plucking tea leaves, capital is the processing machinery, and entrepreneur is plantation owner. So every all these factors have some characteristics of land. First, imagine you own a small plot of land in Kerala where you grows spices like cardamom and black pepper. So what are the various characteristics of land? First, immobility. That is, land cannot be moved from one place to another. So the land where we possess the land at a particular place, you cannot move it to another place. Second, fixed supply. The total amount of land is limited and cannot be increased. Third, original and indestructible powers, that is, land as natural resources that cannot be destroyed. Fourth, heterogeneity. That means different pieces of land have different qualities and fertilization. Every piece of land could have different pros and cons. Fifth, passive factor. That is, land itself does not produce anything unless human efforts are applied. Example could be the fertile lands of Punjab are ideal for growing wheats, while the coastal areas of Tamil Nadu are perfect for fishing and aquaculture. Now comes the second key factor, labor. Now think about the worker in a garment factory in Tirupur, stitching and teaching and tailoring clothes. So what are the different characteristics of labor? First, human effort. Labor involves both physical and mental efforts by humans. Second, inseparability. That is, the laborer and the labor cannot be separated. Means the skill and the person can't be separated. Third, perishability. That is, labor cannot be stored. If a day's labor is not used, it is lost. Fourth, heterogeneity. That is, every labor or every worker has different skills, efficiency, and productivity. Then comes mobility. That is, labor can move from one place to another or from one job to another. Example could be software engineer in Bangalore can switch jobs between companies, but a doctor's work cannot be separated from the doctor. Now comes the third component, capital. There are different types of capital. I have used a practical example for it. Consider a startup in Hyderabad that needs fund to develop new software. So fixed capital could be long-term assets like building, machinery and equipment. Working capital means a short term asset, it could be raw material, cash and inventory. Third comes human capital, that is skill, knowledge and experience possessed by an individual. And the fourth one, social capital, that is network and relationships that facilitate cooperation within or among groups. An example is fixed capital of factories, machinery. Working capital already shared, but I will once again narrate. Cash used to purchase raw material for production. Human capital could be training provided to employee, and social capital could be business relationships and networks. Then comes, there are stages of capital formation. How capital is formed. So imagine you are a farmer in Madhya Pradesh saving money to buy a tractor. So the step one would be saving. You will be setting aside a part of income. Then you will be mobilizing, that is collecting saving from different sources, collecting and making at one place. And third, by using more investment, that is using all these funds to acquire capital goods. One more example is a farmer saves money from his crop sales, deposit his the continued one in the bank, and later takes a loan to buy a tractor, increasing his farm's productivity. Now comes the fourth factor, that is entrepreneur or entrepreneur. Functions of an entrepreneur. Think of an entrepreneur in Mumbai starting a new tech company. So first one, innovation, introducing new products or services. Second is risk taking. What are the functions? So he should be able to take risk, or he must have risk taking abilities. Taking financial risk to start and run a business. Third, organization, that is bringing together all these other factors of production. And fourth, important, decision making, that is making crucial business decision. One more example could be Ratan Tata's role in the Tata Group, where he introduced new products, took risk, organized resources and make strategic decisions. Now comes short run and long run production functions. Think of a bakery in Delhi. In the short run, it can bake more cakes by hiring extra workers, but to expand and more outlets, it need time, and that's the long run. Simply, in short run, some inputs like machinery are fixed. Firms can only change variable inputs, that is, in our example is labor. While in the long run, all inputs are variable. Firms can change everything from labor to machinery to size of the factory. One more example could be in the short run, a local textile workshop in Surat hires more tailor during the festive season to meet the increasing demand. And the example for long run could be the workshop expands its premises and invests in more sewing machines to expand its production facility or production capacity permanently. So these both are examples. Now comes one more important theory or one more important concept, law of diminishing returns. That is, imagine adding more and more sugar to your tea. Initially, it makes the tea sweeter, but after a point, it doesn't improve the taste much. This is similar to the law of diminishing marginal returns in production. A definition for it, as more units of a variable input, just mark it, variable input like labors are added to the fixed input, that is land, the additional output, that is marginal products, will eventually decrease. So I have example for it. A short example is, in a small textile workshop in Surat, hiring more tailors initially increases production, but eventually the workshop becomes overcrowded and the productivity falls. I have a small example, tabular example for it. We have a table consisting of number of workers, total output and the marginal output, that is additional output that each worker is contributing. So I have cases like there is one worker, the total output is 50 and the additional or marginal output is also 50. Now comes one more worker and the total output increases more than twice, that is 110, and the marginal output increases, means the difference from 1 or 2. By adding a second worker, so the additional increase is of 60 units. Then comes a third worker, the total comes to 150 and the additional compared to the previous one is just 40, and slowly you will see there is a decline from 40 to 30 to 20 to 10 and then 5. So I have plotted this on a graph So this is our total output, and you will see a orange line, that is the in a decreasing direction. This is the marginal or additional output that we gain by adding one worker. Now I have one more example. Let's explore a small sweet shop in Kolkata that makes traditional sweets like Rasagulla and Sandesh or Sandesh. First, fixed cost that doesn't change with production level. A best example could be rent. Salaries, there might be some fixed and variable component, but for our example, let's consider salary as fixed. Second, variable cost, that is cost that changes with productions. That could be raw material like milk and sugar. Third comes the total cost, that is a total of fixed plus variable cost. And then comes the marginal cost, that is additional cost of producing one more unit. And lastly, average cost, that is total cost divided by total number of units produced. So I have just plotted this. We have quantity of 0, 10, 20, 30, and fixed cost, that will not change, so it will be fixed of 10,000 in each of the case. Variable cost is depend on the quantity, so it will be changing. For in the first case it is 0 since there is no quantity. Then for 10 it's 5,000, then 9,000, and then 12,000. And total cost will be fixed plus variable, that is 10,000 in first case, 15 in second, 19, and then 22. Now comes marginal cost. Marginal is the actually, since fixed cost is already is same in every case, it is not relevant for us. So marginal will be calculated based on the variable cost divided by total units. So in first case it would be 0. In second case it would be 5,000 divided by total quantity, that is 10, that is 500. Similarly in third case it would be 400, and in the last case it would be 300. So I have written a short formula here. Marginal cost equals to variable cost divided by quantity, and average cost is the total cost divided by total quantity. So in first case it would be 0, in second is 15,000 divided by 10, it is 1500, then comes 950, and then comes 733. Now I have plotted the first component separately and the second component separately. So in the first case you will see this is the total cost. The fixed cost will be remain same, and this is the variable cost, that is increasing as per the output increase. Then comes the marginal cost and average cost. So marginal cost is the additional cost we are taking. So for first case it is increasing, that is we are getting some based on the input or based on the quantity, and slowly you will see that there is a downward movement. Now comes one more concept, returns to scale. Consider an IT company in Bangalore. As it grows, it increases its workforce and office space proportionately. How output changes with this proportionality increase is return to scale. First is increasing return to scale. Output increases more than the proportional increase in output. Then constant return to scale. Output increases in the same proportion to input. And lastly, decreasing returns to scale, that is output increases less than the proportionately increase in input. Don't worry, we have example for it. So example is one more example. I will correct the notes little bit and reduces the example since there are some duplicate examples. So there comes a pharmaceutical company in Hyderabad. First, increasing returns, adding more machinery and scientists leads to more than the double the production of machines. Then constant returns, that is doubling the resources resulted in doubling the output. And lastly, decreasing returns, that is doubling the input results in less than double the production due to management inefficiency. So the decreasing return is majorly due to management inefficiency. So these are three cases for it. This is the base one, that is we have 5 scientists and 4 machinery. Our output is 100 units. That is our baseline output. Then we double the production, that is we add 5 more scientists and 4 more machineries. Our output increased from 1000 to 2008, that is increasing return to scale. Then we further add 5 more scientists but keeping our machinery same. The output is decreased to 2000, or you can say constant one, return to scale. Actually it is reducing one. And third one, I think there is something error in this example, let me check. And then comes we have 15 scientists and 12 machineries. The output is, I think there is some error. Yes, there is some typo error. This could be a decreasing one, and last one is constant one. So you can see there is an increase, and after that there is a decreasing trend. Then comes one more example or one more point: production optimization, that is using isocons and iso cost curves. So imagine a dairy farm in Gujarat trying to balance between the more labor workers and capital, that is milk machine, to maximize milk production. So isocons, these curves that shows different combination of inputs that produce the same level of output. So we have an example for this. And then comes iso cost lines, that is lines that represent all combination of inputs that cost the same output. And optimization is achieved where an isocont is tangent to an iso cost line, indicating the most effective combination of input. Simply we are we are aiming for an optimization or a level where our production cost will be less and our profits will be higher. So we have example for it. I just continued the example. So we have four combination A, B, C, D, and we are the labor cost per worker is rupees 800, milk cost is rupees 3000 per machine. We have kept fixed cost as 0, variable cost we will be calculating in each case, and we will be calculating all the other. In first case we will be calculating 5 workers into 800 plus 4 machineries into 3000, that comes to 16,000. So our variable cost will be 16,000, total cost will be also 16 since fixed cost is 0, and total output is 100 liters. So the average cost will be 16,000 divided by 100 liters, it would be 160. So similarly we have calculated in all the cases. In second case it is 13,800, then 11,600, and then 9,400. By all this combination, we can see that in the fourth case the total cost is lesser, which will help us to maximize our profit. Since the cost will be less, the profit will be higher. By selecting combination 4, the dairy farms achieves the desired milk output of 100 liters at the lowest cost, thereby optimizing production. I have explanation for it. Isocons are the combination A, that is 5 workers and 4 machineries produce 100 liters of milk. Similarly 6 worker and 3 machineries also produces the same 100 liters. And we have 2 more, combination 3 and combination 4. Each combination of worker and machinery yields the same output of 100 liters, indicating different way to produce the same quantity of milk. Then come iso cost lines. These are combination of cost. So in first case we have cost 16,000, that is fixed cost is 0 and variable cost is 16,000. In second case it is 13,800. In third case it is 11,600, and in fourth case it is 9,400. The explanation is each combination has a different total cost due to its varying number of workers and machinery. Then comes the optimization. Our objective is to minimize the cost of producing 100 liters of milk. So we have calculated the average cost per liter, that is 160 in first case, 138 in second, 116 in third, and 94 in fourth. So our result is combination D is the most effective as it has the lowest average cost per liter, making it an optimal choice. Then comes one more topic: enterprise objective and constraint. Imagine you run a small bakery in Delhi with a vision to expand it into chain. So our objective would be profit maximization, growth, market share, and social responsibility. But there are some constraints, that is limited resources, market competition, government regulation, and economic condition. So all these problems are discussed here. First comes economic problems, that is consider a family in Rajasthan deciding how to allocate their monthly budget. So there comes first scarcity, means limited resources to meet unlimited wants. Then comes choice. So deciding how to allocate resources, we have various alternates. And third comes opportunity cost. So it is a very important concept. Opportunity cost is the cost of forgiving the next best alternative. Example is a family chooses between buying a new TV or saving for the vacation, with the opportunity cost being the option they forego. Means what's the loss we are having? Suppose we are choosing option 1 which has a value of 100, and the second option which has a value of 95. So in the case our opportunity cost would be 5 rupees, the difference we are forgiving, if in case we are choosing for the 100 instead of 95. Then comes MG Extra. Like every video, we have a short activity which will help you to understand some of the concepts in a more practical manner. So the activity is, first, visit any two different grocery stores and compare the prices and variety of the same product. Also consider factors such as store size, location, and the customer they are targeting. And the second activity is, visit to a farmer and analyze how they are currently using their land and resources. To plan how changes in the combination of inputs like fertilizer, water, and labor could increase their crop yield efficiently. And in the conclusion, considering all these four factors, one can make better decision in the business, which will help to optimize its resources and maximizing profit. That's it from the video. Thank you. Bye bye. Keep learning, keep growing.